Christmas is around the corner. And just like we Indians buy on Diwali, foreign investors make use of this auspicious occasion of Christmas to make their buying. But is Santa Claus rally in the stock markets real? Does data support that there is a rally around Christmas, not just in the US market, but also in the Indian market? What will happen when 2023 ends and 2024 starts? Will we see a Santa Claus rally this year? In today's video, we're going to talk just about that. But before we begin, please don't forget to like this video and subscribe, as well as put down in the comments what you want us to talk next.
So, what is the Santa Claus Rally? The Santa Claus Rally refers to a trend where stock prices often rise in the last 5 trading days of December and the first 2 in January. This trend was first documented in the Stock Traders Almanac way back in 1972 by Yale Hirsch. Historically, the S&P 500, when we look at it, has given an average gain of about 1.3% during this 5 plus 2 7-day period. It's been observed consistently more than 75% of the time since 1950. And as you can see in this graph on the video, you can see a 10-year period from 2011 till about 2021, and there have only been 2 occasions, which were in 2014 and in 2015, when the rally was in the negative territory. And all other results, all other rallies in these months have been positive, and they have shown essentially, when we look at it, more than 50% of the time we're seeing a rally which is greater than 1% in this last 5 days and 2 days in January, right? But there have been occasions when this hasn't held up. So for instance, in 2022, what we saw was there was no Santa Claus rally, primarily because there were fears of a US recession, banking crisis. A lot of global macroeconomic factors were sort of not lining up for the stock markets, and ultimately there was not a rally. And what will happen in 2023? Well, be sure to watch till the end of the video to find out. Despite a few exceptions, the Santa Claus rally has shown some consistency. But as always, what we need to remember is past performance is not a guarantee for future results. Nothing is ultimately set in stone when you're investing in stock markets. The Santa Claus rally is definitely one of the stock market's most interesting patterns that we can observe. And it is also a sign, some people believe, to be of how well the market will perform in the coming year as well. And ultimately, as viewers and subscribers of Wright Research, we want to look at this from a more data-driven approach. We want to sort of scrutinize whether this is actually true, and we will do this by looking at it from a statistical lens, looking at the data, and to see how significant the rally has been beyond historical performance. Finally, before we get into it, we've also covered the October effect, which is a phenomenon very similarly related to the Santa Claus rally. It was in an earlier video and a blog. Be sure to check it out as well.
Let's look at some data and analysis to support this thesis. If you look at the chart on your screens, you would observe a very interesting trend. In this graph, we can see there's a lot of positive movements compared to negative. Since 1950s, S&P 500 has given an average return of 1.32% during this period, and positive trades have occurred 78% of the time. This pattern is not just unique for S&P 500, the Dow Jones has also experienced a similar uplift, averaging a 1.38% increase during the holiday season, with a frequency of 79% since 1950s. Now let's look at what happens in the post-Christmas trading days. So if you look at the chart on your screen, you would see that the 5th to 6th trading day after Christmas generally shows a positive returns. Gains during the initial days were notably higher than the global daily average of points, particularly in the 1st, 3rd, and the 6th days. After the 6 days, there seems to be a downward shift. Also, please note that the gains on the 1st, 3rd, and the 6th days are statistically significant. What that means is that there's a clear pattern. It's not just luck, but there's a trend that is forming. Another important data point to look at is the number of positive trading days during this rally. As you look at this chart, you will see from 1951 to 2014, S&P 500 saw positive days 53% of the time. However, during the 10 days after Christmas, this average slightly increases too. So while this might seem like a marginal increase, there is a clear indication that Santa Claus is in fact present. If you look at this data in more detail, you will see that the first day after Christmas has the highest positive outcome at 69%. And the initial days after Christmas consistently show a greater chance of gains than the year-round average. In contrast, the last 4 days of this 10-year period fall below the global average, and the final 2 days seem likely to show losses. Finally, if you look at the cumulative returns over the 10 days, the graph looks something like this. If you were to invest close to the Christmas day, the likelihood of making a profit remains stable at 66% during the entire 10-day period post-Christmas. This means that the overall trend after Christmas tends towards positive returns. With all this data and market observations, we can confidently say that the period between late December and early January seems to carry a statistically significant trend and can be a positive trend. The repeated occurrence of these trends hints that this is not a chance occurrence. Now that we have looked at the data, the next step is to identify why this happens.
So now that we've looked at the data behind it, let's try to understand why this happens. It's kind of difficult to pinpoint the exact reasons, but we can try to come up with some explanations as to why this rally happens. The first is the festive spirit. We are approaching the end of the year. It's Christmas, New Year's is starting, and everyone is sort of filled with optimism. There's a lot of positivity that's flowing around, and that kind of trickles down to investor behavior, which encourages more investments. People may also get end of year bonuses, especially in the US where the financial year typically ends along with the calendar year, and people also get certain holidays and they get gifts, and a lot of that sort of goes into meaning that you may have more money in your hands, which means you may invest more in the stock markets as well. The second is that there is a concept of institutional investors who sort of start winding down some of their activities as people go on holidays and leaves, which means that there is lower market volume and activity from their side. What this could also mean is that there's a lot more interest from the retail investors, which means they may tend to be more bullish, which can have a more impact on the markets as well. And ultimately, as we see lower impact of the institutional investors buying and that sort of trading volumes dip, we see a sort of pick up from the retail investing side as well. The third point here is more related to the US stock market. It has over time and in history influenced global markets, and that is sort of waning down over time, but it still is a very important force when we look at global stock markets, including Indian stock markets as well. And what we see is that a positive trend in the US stock market or the US investor sentiment can have a ripple effect for the worldwide stock markets as well. Post-December, a lot of the times US investors are looking to maybe reinvest funds that they've sold for tax loss harvesting, which could also lead to a demand increase for stocks. And ultimately, it could also just be a self-fulfilling prophecy. We all are getting aware of the fact that there is the Santa Claus rally. It's been there as a phenomenon in the market for a while now. And as more and more investors such as yourself get aware about it, you may inadvertently contribute to it happening as well. We've looked at the data for global markets, specifically for the US market. We've also tried to understand some of the reasons behind why the Santa Claus rally might exist. But does it exist for Indian stock markets? And that's a very pertinent question because we are here as Indian investors. We want to invest in the Indian stock markets. So will it have any impact? Historically speaking, like we said earlier, US markets have had an influence on Indian stock markets as well. And as you can see in this graph, the Nifty 50 has experienced the Santa Claus rally 13 out of the last 16 years. And this trend is indicative of a strong year-end performance for the Indian markets, which aligns with the global pattern that we've seen for the Santa Claus rally as well. As you can see in this graph from the Economic Times, we see that over the last 21 years, and this was a period between 2001 till about 2021, Nifty has provided an average return of about 2% during the 7 days of the Santa Claus rally. And finally, you can look at this table here where you can see the S&P 500 being compared against the Nifty. And as you can see, there is a very similar correlation and sort of a movement, at least from a trend perspective, between the US market and the Indian market. There are natural variations, for instance, in 2018, partially in 2017 and 2016 as well. But on the whole, there seems to be some sort of a movement or some sort of a trend that when the US market is moving well in these sort of 1-2 weeks, we see that sort of continuing on for the Indian stock markets as well.
Data suggests that the Santa Claus Rally is a significant event, particularly in US and the developed economies. Investing just before Christmas has historically offered a 66% or greater chance of profitability. The optimal strategy seems to be buying just before the Christmas day and selling 6 days later. And the average cumulative returns seem to be 1.2%. Indian markets have also shown a tendency for a year-end rally. But it is crucial for us to be cautious and not to solely rely on historical trends. Recently, we've seen an early Santa Claus rally. Market indices in the US, Germany, France, and India have hit historical highs. But last Wednesday, the trading saw a very sharp downturn due to COVID fears and profit booking. This downturn, in fact, raises a question. Will the markets rebound as we transition from 2022? Will the markets rebound as we transition from 2023 to 24? Or will the trends reverse? For the US markets, factors like FII and FPI flows, as well as the activity in the US market, is extremely crucial. So, what can we expect? Historical trends do show a probability of a rally just after Christmas, but the recent downturns have put in a sense of caution in investors. So, what do you think will happen this Christmas, and what are the trends that you see happening in 2024? Comment below to let us know. We wish you a very happy Christmas and a joyous New Year. And we'll see you the next time.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Don't forget to